tonight we will be talking about the most common tool for order flow analysis, which is the footprint chart. So I guess it will be something really interesting, especially considering that today the intraday session of the S&P 500 gave us so many examples to be discussed about. So we will be doing that in a few minutes. Meanwhile, I'm just gonna share my screen as usual and have a quick overview of the S&P 500 so that we can also take advantage of these few minutes to recap a little bit what we have been talking about over the last webinars. Um, so as you can see today, according to price action, we had definitely a really strong downside move. We can spot that from all of actually my time frames we can see here, both the long-term time frame and the shorter-term ones. Could that move be somehow, well, I don't want to use this term predicted, but could have we prepare actually to catch such a move? Well, definitely yes, for two reasons. First of all, if we look at where price was today when the session opened, we were here. Yes, we were here. And we can see that we are on the upper edge of a bell-shaped curve on the composite volume profile. That's the composite profile taking 350 days. So definitely a longer term volume profile. And we had the failure of breaking these two swing highs, those previous swing highs, representing previous resistance points, both in terms of price action, but also in terms of volume, because we can see that yesterday we had market trying to push here to the upper edge of these previous swing highs, but apparently it failed right before closing, and that could have been also spotted by the order flow, because yesterday when the S&P closed, we had the release of data from some of the major stocks being listed on the S&P 500, and we could spot a really strong yesterday, a really strong ignition of short contracts being traded to the downside, exactly as it tried to put lots of effort going upside and then failing. So basically, an absorption, as we were talking about last week. And then that could have been considered as a rejection. Then after market started to accept below its first high volume node finding on its way, and of course, considering that this possible support has been broken and acceptance started to build below this previous level of support area, then of course it was the major evidence of a downside bias, which has been completely confirmed after the cash market opened. We had this nice move here, rejecting completely the VWAP and the standard deviation, and also can you see in this box that's a value area coming from a market profile. Market started to accept below and here when the drop straight back to a previous area of value still achieved from the market profile analysis, as we were saying a couple webinars ago. So for this reason, now S&P 500 continue to move to the downside, and as we can still see here on the composite profile, we have flat area. So that means that apparently this possible distribution area is supposed to end somewhere here. Okay, so price has found relevant acceptance over this area. So apparently we don't have any support at the moment in front of the price going down. For this reason, of course, I'm gonna keep downside bias, just a personal view in terms of analysis for the rest of the session, which is for still a couple hours. The thing is, though, last time we have been talking about absorption, exhaustion, and initiative moves. So basically, the most relevant and most common order flow events. We have talked about how to spot identify them using delta-based bars, using POC of every bar. So as you can see here, we can see some nice example, like in this bar. We can see here price going down. That's a down bar. That comes with a POC, a POC for the bar, with a dominance of buyers, of aggressive buyers. But despite all of those buyers being aggressive, price couldn't move further up. So that means there was an absorption of buyers here in this area, okay, which then led price to move further down. Tonight, we are gonna take this concept and transfer it to the footprint chart, which is the most important, and I would say the most complete tool in terms of order flow analysis. This is what a footprint chart looks like. First of all, I know that it can look a little bit complex at first sight, but no worries. Before applying order flow concepts to this kind of chart, we're gonna discuss on how to read it, and even before that, we're gonna discuss how to decipher the information it is able to give us, and what kind, of course, of information it is able to give us. First of all, what is footprint chart? It is basically a chart, a normal chart. Well, not completely a normal chart, but sorry, it works exactly as a normal chart because, as you can see, it has to come with an underlying time frame. So we can set it with a time-based time frame, like 1 minute, 5 minutes. It can be based on a range basis, exactly as well as those plane charts here I was showing you on our first webinars. So what we get from this chart are kind of normal price bars, but with something particular. That means that we can have a look inside every single bar, or it would be better to say we can have a look inside each tick the bar has gone through, because over each tick we can have the information of how many contracts were traded on the buy side and in the sell side. Of course, talking about selling or buying orders, for footprint chart, it is specifically focusing on aggressive orders. So all of these numbers that you can see here in each bar are the number, would represent the number of aggressive trades who have been hitting the ask side of the DOM or the bid side of the DOM. So respectively, aggressive buyers, which are the ones we can see in the right-hand column of each bar, and aggressive selling, the ones you can see in the left-hand side of the candle. Okay, so this is the first information we can get from footprint. So it is like a magnifying glass of what happens when we get on specific price levels, especially if they are structural levels that we have been uh, at, finding them through a more general analysis from maybe the volume profile or the market profile. Okay, so ideally, this is a tool for validating trade. It can also be used as a tool for a standalone analysis of the order flow. But in that case, I would recommend using higher time frames. So if I want to conduct an independent analysis without using volume profile or market profile or some other structural tools, I would definitely have to go for a higher time frame. So for example, if I want to just validate a possible trade idea, then yeah, I can decide to use maybe a 10 tick range like this one, or maybe a 1 minute chart. If I want to use order footprint to have a general idea or to make a more structural analysis of that instrument for that day, for that session, I would rather have to go for maybe a 30 minutes or maybe a 24 or a 30 range for the S&P 500. So it can be used in both ways. Of course, both ways you are using this tool, you can use the very same informations according to the time frame you are using. So it doesn't matter which time frame you are using the footprint. Whatever you see, whatever you read, you can apply that to every time frame you want. So we have buyers on the right side and sellers, aggressive seller on the left side. So of course, for each level, we will have a number of transactions, right? If we sum up the buyers and the sellers, comparing them horizontally, of course, what we have is the total volume transacted by price. And this information is also given graphically by a specific small volume profile showing the profile shape within the candle. In fact, as you can see, there is a dark color here, so I'm gonna choose another candle just to make the example more clear. No, not this one. Let's get this Okay, let's get this level. We have a total of 575 contract traded at this price. 374 sold aggressively the price level. 201 bought aggressively the price level. Okay. In fact, as you can see, this price level comes with the longer high volume, the longer volume histogram within the entire bar. This is what is the bar, the POC for the bar, exactly as well for a daily volume profile. And that's the reason why, according to my visual representation, it is highlighted in yellow. The example is even clearer in levels like this one. If you look at the entirety of this bar, you can see that every single level didn't come with that much of a volume traded, except for this price tick, where we had over 300 contracts traded. In fact, that's the price tick for the entire bar containing the highest volume, the highest number of volume. Okay, so basically apart from the POC for the bar, what's the important information provided by this volume profile? It's gonna show us where, according to the length, the width of the single histogram, the areas where the highest volume was traded, and on the opposite side, the area where not that much volume has been traded. Like here, you can see volume histograms here are very tiny, not that impressive like this one, for example. Okay, and this is the first important information we have. Then you might have noticed that each of these histograms also come with colors, and more specifically, the two color coding we have is green and red, even though with different shadings. Okay, the color, according whether it's green or red, let's not talk about how dark or light that green or red is, it gives us what is called the horizontal delta. What do I mean by horizontal delta? That's the difference between buyers compared to sellers taken horizontally. So the comparison we make in order to calculate the delta, so the difference, and according to that, who was more dominant, who has been trading more contract in one specific side. In this case, as you can see, we have 374 contracts selling and 201 buying. That means the horizontal delta comes for this specific price tick with a dominance of sellers, and that's the reason why the price tick is red. Same as an example on the other side. Let's get, for example, these. We have here 1.3K by aggressive buyers versus 1.2K sellers. That means that buyers here were dominant if we compare them horizontally. So in this specific price tick, the horizontal delta is positive. But then, why are some green level lighter and some other darker? Well, the shading of the green or the red is given by the how strong actually that delta is. If we have, like here, yeah, dominance is of buyers here. Buyers were dominant. But if we compare 1,300 with 1,200, there is only a difference of roughly 100 contract. So delta, it would be plus 100 and something. Is not that much compared to the total volume of contract trades traded on that level, right? That's why the algorithm building the footprint as an indicator decides to print that level in with a light green, because it recognizes that, yeah, there is a positive dominant delta, but not that much positive compared to the total volume, as opposed to other levels where, for example, yeah, like this one, that's a strong green because we have 517 aggressive sellers versus 1,100 aggressive buyers. So we can, of course, dominance is on the buyer side, but that's a much more relevant dominance because we are talking about those contracts selling doubled. It's it's over twice the people that were selling, those people buying. So that's the reason why delta in this case comes with a dark shading. Of course, the exact same analysis comes for red levels. Red levels show dominance of sellers. The darker it is, the stronger delta is in dominance of sellers. This is one of the two key aspects of the footprint analysis. What's the second one? The diagonal delta. Why is it important also to consider delta diagonally within a footprint candle? Well, for a very easy reason. Uh, if you remember when we were talking about market microstructure, market never trades bid and ask at the same time. If we are trading a specific price level, let's say here, buyers, and let's assume this price level is 4,000 even, okay? Buyers, according whether the market is trading here bid or ask, buyers would buy aggressively. Let's assume it is trading the ask side 4,000. But at the very same time, whilst those aggressive traders hit the ask, what are aggressive sellers doing? They would trade the bid. I mean, if whoever wants to sell aggressively, it will have to do at the first available bid, which normally is below the current ask. So ideally, it would be 3999.75, one tick below. Normally, there is a spread of one tick, ordinary spread in futures market, as long as there is enough liquidity, as normally there is. So if we want to make a comparison between who is stronger in a micro auction, of course, we have to compare buyers buying, how many buyers were buying aggressively on a specific ask level with those selling aggressively at the tick below. If you want to compare the strength of sellers, we can do the very same process, but in the opposite way. We need to see how many aggressive sellers are selling here, comparing them with the buyers, the aggressive buyers at the tick above. That's the reason why is it important to also consider a diagonal comparison within a footprint candle. Because when we have a strong difference, a strong delta taken diagonally between buyers and sellers, we have what is called an imbalance. When can we say we have an imbalance? Well, when the diagonal delta goes beyond a certain threshold. In this case, you can see that some of the numbers showing the number of contracts don't come with a black ordinary color, but some of them are highlighted in pink. This representation is specifically to highlight imbalances over 300%. That means that indicator shows me I have an imbalance according to which side it happens. Because, for example, here we had 522. Let me just delete the previous one. In this case, why do I have an imbalance? Because I have 522 contracts on the ask side. If we compare them diagonally with the bid below, that's only 121. So I definitely have a strong imbalance, stronger than 3 times actually what was traded on the opposite way diagonally at the tick below. Same thing, but it has to be looked the other way for selling imbalances, which of course will show on the left hand side of the candle. This is a little bit weaker, but still good. We have 102 contracts here sold on aggressively sold on this level. If we they are on the sell side, but why is that a selling imbalance? Because if I compare that with the aggressive buyers which were trading the tick above, we have 102 compared to 7. there's a lot of difference, way more than just 300%. So the indicator highlights this price tick, this price number here as a selling imbalance. A personal suggestion I would like to give you, of course, if we just base ourselves on an arbitrary threshold to determine what it can be considered an acceptable imbalance at what it can't, well, I would say normally 300%, it's arbitrary, of course, so there isn't a right or a wrong way to decide how to set your imbalance settings. Let's say 300%, it's in the middle, okay? It's not too much aggressive, but not that much conservative as well. It's exactly in the middle. Personally, if you want to have a reliable indication of those prices and filter out a little bit those imbalances, which in a little while I will tell you how to consider them in your trading, I would either increase the percentage. So for an S&P 500, if you want to be more conservative, I would go for 500%. But personally, since I'm a scalper, I'm fine with just at 300 because I want to see more of them, and then I'll decide whether to consider that as good or not. That's just my personal filtering scheme. Okay, but if you want to be more conservative, definitely you might want to increase the percentage of imbalance, or either leave it to 300 but filtering that with volume. So highlight every imbalance you have going over the threshold of 300%, but only show me those trading at least, for example, 100 volumes. This is another way to be more conservative and having less of these imbalances shown on the chart, only the best ones, let's say. But why do you want to filter out imbalances? Well, because what do they represent? They represent initiative. They represent buyers or sellers initiating a move in one side. What do I mean by that? You can notice that wherever we have imbalances, in whatever area in the footprint you can spot imbalances in both sides, you don't really have that much volume traded. Can you see histograms are tiny? Horizontal delta as well is quite light, but we have imbalances. That means pressure. That means buyers or sellers initiating a move. That comes with an implication, though. How is it possible that such a low volume like here is able to move price so quickly compared, for example, to this area where we had lots of volume traded, but apparently price struggled a little bit. to get away from these 4 ticks area? Well, because apparently if this low volume is able to move price so much, that means that in the DOM, those aggressive buyers or sellers are not finding enough counter liquidity. So they don't have so many passive orders in the counter side holding price on those levels. And if we translate that into one of the first principles we have been talking about in the first webinars, the effort versus result relationship, that means that with a very low effort, market achieves great results. It is able to move price is able to move with very less effort. Well, sorry, with a very low effort. Because there is not counter liquidity. But what happens when there is not that much of liquidity? And traders are initiating in one side. Well, the initiation of trading one side without counter liquidity, that means that those traders are actually seeking for liquidity. That's why price moves so quickly. And also that's why imbalance in terms of percentage create. Because normally the mathematical relationship in order to have an imbalance it is easier to happen when we have low numbers involved. On the other side, what happens where in price areas where we don't have imbalances? We tend to have high volume, normally high horizontal delta, so darker shadings. But as you can see, there are no imbalances here most of the times. Why? Because apparently those are the areas where, since there is more volume traded, more volume is involved. If more volume was able to trade on those areas, that means that there had to be the counter liquidity to allow them to execute their trades. Those are areas where more liquidity was provided. That's also the reason why there tend to be not imbalance there, because buyers and sellers tend to be more balanced each other and more volume is involved. But so basically that's also the reason why is it important to consider both diagonal delta to spot where imbalances are, but also horizontal delta, because horizontal both diagonal and horizontal delta will give us an idea of how strong intentions of both participants are on specific levels, but in a different way. Diagonal delta with imbalances is the immediate push on one side, and it shows when a proper initiative is getting into play. Horizontal delta is more indicated to show, first of all, where market has found liquidity. Let's get a proper example. Yes, that's perfect. Price made a nice down move right here. One imbalance here, low volume, light delta. Some higher volume here, but then price started again going down. Two imbalances to the downside, low volume. Some more volume getting here, but still pushing to the downside. And then here, high volume and high delta. So still in a rough way, but definitely right, we can tell that during this probe to the downside, sellers were looking for liquidity. And at a certain stage, they found them because more contracts were able to transact in a balanced way. So we have two different phases, basically. The initiative part of the move and the responsive action. By responsive action, I mean where sellers go down because they are aiming to find new buyers at a cheaper price, because apparently if there are no buyers here, it will be easier as we go down to find more traders willing to buy at cheaper prices, okay? As opposed to an up move, it will be easier as price goes up, find new sellers. At a certain stage, buyers step in. First of all, they just show up in still a shy way, being passive. So sellers push to the downside, hitting the bid aggressively, creating imbalances and pressure to the downside. At a certain stage, you can see at the very bottom of this bar, you can see lots of red delta here, horizontal delta, but with price not only being not able to follow through, but on the opposite side, bar closes up. So how is it that possible? Lots of sellers here and price goes up. Well, there has to be a reason. Talking about absorption, as we said last time, what's the possible reason? As sellers were hitting aggressively the bid, the sell side, at a certain stage, there were more buyers stepping in, being in the bid side of the book, of the order dome, with buy limit orders. Talking about delta, the delta measured by the footprint indicator, delta is affected only by aggressive orders. So whatever happens in the order book as limit orders, of course, it won't affect delta in any way. Here in every single delta, we only see the aggressive order. So if there are many people buying here with limit orders, that won't show at all in the delta. So the result is, if we have lots of red not going down, it has to be because there were a buying force holding that price level, buying, absorbing all of this selling pressure. If buyers step in on a down move, they have responded to the sellers seeking liquidity, seeking for new buyers at cheaper prices. They have responded to that action. That's why it is called responsive buying. So basically, we can consider responsive action areas as areas where buyers and sellers are basically fighting each other. Okay, so as we said last week, this is exactly what happens during absorption. Absorption is an evolution of responsive action. They are basically synonyms, but responsive come a little bit earlier than proper absorption. Because in order to determine there was an absorption of sellers here, we need to look for the evidence that apparently buyers have won the battle. And can we really tell buyers have won the battle whilst we are still here? Just imagine the bar being here, not having closed it yet as an up bar. Can we really tell, looking at this volume, oh, buyers have won? Well, not at all. We are still within the fight. When do we have a slight evidence that buyers have won? Well, I would say somewhere here. Why? Because of the imbalances? Yeah, definitely. But not only because of that. Because those imbalances come, first of all, above the previous level where sellers were apparently struggling, let's say struggling. We don't know yet whether they won or not. Let's say they were, but that's an evidence that they were struggling. They weren't able to move price farther down. But also, they've tried once again bringing price down, which an effort which is nothing compared the previous one. Look at that. Yeah, we have initiative going down here, but it has completely dried in the next candle. If we only look at the sell side, here we had 958, 524, 473. Here we have 200, 126, 103, then 18, 12, and then here comes the push on the other side, not finding counter liquidity in the order book. So from here on, we can definitely say, okay, that was a battle. buyers have won. Then we can say at this stage here there was an absorption of sellers. To be honest, not only an absorption, which was there definitely was an absorption, okay, according to the analysis we are conducting together, but there was also something more, which in this case happened quite quickly. On top of the absorption being validated once we spot the counterforce coming in the other way, we also had here exhaustion. Why exhaustion? Because exactly for the reason I was talking about a couple minutes ago. The push, the further attempt to break down the level came with a relevant decrease of participation on that side, looking at the seller side, compared to the previous participation we had, even if that was a struggle for them. But still, there was participation. Here, there's not any participation anymore, or at least that's way less than what it used to be. So just with this example, we have gone through both of the order flow events we have been talking about last time. But looking at those from the footprint chart perspective, I'm sure you all agree with me that's a way more accurate tool compared to cumulative delta, delta bars, and all of everything we have been talking about before that. Well, I wouldn't really say that that's better than those other tools. I would say they just have to be considered from different perspectives. Let's say, just to make a metaphor, footprint chart is like a pair of glasses which allow to see from here to, let's say, 100 meters. That's a very short time frame, unless we don't use higher time frames. Cumulative delta gives you a wider perspective, 500 meters. Delta bars, delta base bars, as well as their POC, if that's an absorbed POC, just stand in the middle, 200 meters. So that all of those are important. It's just the perspective changing. Of course, that's an amazing example. Look at that. Here we had a really strong effort to the upside because we have a really strong delta, positive delta, but price wasn't able at all to move further up. Was that absorption? Yeah, definitely there was. But when were we able to tell, oh, that's a proper absorption? We could have said that here after we have imbalances to the sell side showing on the as the bar closes down. In this case, we only had absorption. We didn't have, as in the previous example here, another attempt showing also exhaustion. That's why sometimes it is hard to make an automatic or mechanical analysis based on order flow dynamics, because they can show in many different ways. It's impossible to have 2 or 3 patterns representing all of the possible situations. Based from my experience, uh, especially if you scalp the order flow, I mean, you're using this concept to take quick scalps, you will never have two identical setup, never in your career. There will be always something different, some nuances will always be different. But let's go back to this situation. Then literally a mess happened, because as you can see here, we have plenty of zeros. What do zeros mean in the footprint? Well, that means that that side or that price tick wasn't traded. So if we have double zero like here, well, it doesn't really mean anything. It means that that's a gap. Exactly as well as a gap you can spot on a plain candle, which sometimes it is quite rare, but as you can see, sometimes it happens. Fast market conditions. So price will just slip a few price ticks, and of course, since those levels weren't traded, we have 2 zeros. Otherwise, we have zeros only in one side. What does this situation mean? That what is called sweeping. That occurs when we have an enormous push in one side of aggressive buyers, which would, being so aggressive with so many contracts compared to the one being traded in the correspondent side of the book, of the order book, that we have the aggression involving more than one level. That means that in just a millisecond, price gets from here to here. And those are the contracts which hit aggressively every single side of the book, which of course let price tick up because there weren't liquidity at all to hold price. And since price spiked up so quickly, so suddenly, market never went bid whilst this spike up was creating. So that's the reason why we have zeros. That's aggression. That's another evidence of a specific aggression. I mean, exactly as well as imbalances, but those are showing an even stronger aggression. Okay, so that was just to explain this particular situation which happened over here. But I want just to recall your attention on something interesting, so we can have also a couple of minutes for possible questions you might have. Here, when we said where can we really tell that price sellers were absorbed, somewhere here, when the initiative move after the further exhaustion pullback took place. Cool. Where did the price bounce back? Showing actually something similar. Exactly there. Exactly there. Of course, this is not the holy grail, okay? But it is just awareness. Order flow is mainly supposed to give awareness of why a specific price move happened and where it actually gets invalidated. Does that mean that I could have entered here or here? Well, actually, both were good. And setups, of course, have to be built upon the dynamic we are looking to trade. Setups can be strategies around the order flow dynamics can be built in lots of different ways. But the most important thing to remember when thinking of the setup is the underlying dynamic. If this level doesn't hold anymore, that means that the support is breaking. A support, why is this area support? Because not because market created a low, but because sellers have lost the battle and buyers have won that battle. That's the only reason why we can consider that area as a support. Okay, so last interesting thing I want to show you, pressure areas and their implication. This green band here, where does it come from? It comes from at least two imbalances in a row of at least, according to my settings, 100 contracts trading on that imbalance. Of course, that shows initiative. Does that show initiative or a responsive action? Well, definitely initiative. I would say quintessentially initiative, because it is a pressure, an imbalance, which is particularly strong. In this case, the band is green because there was an imbalance of a pressure given by buyers. And this is what happens when price bounces back. So we can consider those areas quite easily as possible supports or resistances. Here we can see that after bouncing on this level, then price starting to push to the upside once again. So there was a confirmation, a further confirmation that actually support was trying to hold it, the area, as opposed to when price comes back, what happens here? Well, exactly the opposite. Many buyers trying to buy aggressively, but failing. And when do they fail? When we have pressure on the other side. A support gets broken, a previous support area gets broken, here it goes the other way. This is a very nice feature of Falsys platform. Actually, you can set it up to have this area shown. The indicator is called imbalance tracker. I have to correct myself, the threshold for imbalances wasn't 100 but 50. But still, then you can decide whether to extend the band for a specific number of bars. You can decide what color you want to give to those areas. You can decide whether to delete the band once the price just touched the area, or if it just the next candle closed below the area or above in the opposite direction of the original pressure. So this is a very convenient features because it just gives you at first sight where support or resistance area could be, possible reactions area could be. And then when price gets back there, of course, the best approach, I would say, is to assess what the actual order flow is doing. It doesn't mean, of course, the evidence of something which already took place, it doesn't mean necessarily it has to happen once again. But the assessment of that possible outcome, looking at the current order flow, at the current behavior of price, gives you definitely the best way of looking and analyzing the order flow. And that counts for every time span you want to use. Okay. I think time is almost over. Well, we went a little bit over, so if you have got any questions, please feel free to ask me. Tonight, we have been going through maybe the one of the most complex, actually, uh, topics in terms of order flow analysis, and it is really, really hard to just summarize that in just 1 hour. Those are things that during my education, uh, an entire module of 6 and over hours is dedicated to the footprint analysis, but I hope that I could be clear enough at least on how to read informations. No questions, I guess. Cool. Hopefully I've been clear. I've been clear enough. So we have completed also the second module of our path of webinars. From next week on, we will be getting started with the third one, talking about Hitman, which will be another additional tool for order flow analysis, focusing not only on aggressive orders uh, as Footprint does, but also passive orders. That means liquidity, and exactly it will be something looking like that, just to give you a quick idea of what we will be talking about. Thanks to you all, guys. Thanks to you all for your interest week by week. I'm really glad to be together on all of these webinars. Okay, that's it, I guess. I wish you a good night and see you next week.
You too, Edoardo. You have a good night. You have a good rest. Thank you for your time and thank you for the lovely webinar one more time.
Thank you, Alex. You're
Have a good
welcome.
night, everyone.
Cheers. Bye bye.
Bye, bye, bye.